We're just going to rip up the script because we're going to start with setting the scene and the Fed and getting Roger's take, but we've got some news here, as Tyler mentioned, on the Bank of England and what's happening in the UK. Can you explain what's happening there?
I will do my best. So, this panel is about investing in the whole discussion of delivering alpha, and I think the main theme is delivering alpha has become much more challenging. We start with what is well known, which is here at the US, the Fed is in a tightening mode. Don't know where it's going to end. I'm not sure they do either, but they've been very, very clear about it. And we have some good news, which is that markets are now totally aligned with where the Fed's likely to be. On the other hand, this morning, as we just heard, very interesting, I would say even dramatic news from the UK. We rarely see major central banks intervening this aggressively, but they have chosen to intervene in order to basically drive or manage their interest rates not up but down, a reflection of responding to markets. And what's fascinating about the UK situation is that interest rates have been rising as a result of the new budget that the Chancellor announced a little while ago, and at the same time currencies, the UK currency has been weakening. Highly unusual set of circumstances forced the UK central bank into action in order to create stability, as I think they described it in markets. So a very, very challenging time, very interesting time, and I'm looking forward to the conversation.
So can you invest in the UK right now, Mary?
So Roger is one of the greatest investors of our time, but I just want to make a slight nuance on it's impossible to find beta right now, positive beta. It's actually the easiest time in the world to find alpha. There is alpha everywhere. The little title somewhere said, where is the alpha now? It's everywhere. It's in stocks, it's in bonds, it's in currencies, it's in real estate, it's in private markets, it's in public markets. Like, it's everywhere because we are in such a state of change. We've gone from an entire world being in QE to quickly changing. We've had 43 central banks make 253 basis point moves to total 22,000 increase in basis points over the last year and a half. That is a complete reversal as to what we've done, faster and a steeper curve than we've had, much faster than the Greenspan era. We've got globalization turning into deglobalization. We've got offshoring turning into onshoring. We've got energy vilification turning into energy independence being a very important thing. And we have entire companies that have come to market based on just their TAM, which is the total addressable market, as opposed to EBITDA, which is now back in fashion. So you have an entire world that's shifting. You have markets that are moving. And of course, the currency markets are the most volatile and wide-ranging markets that there are. And so everything is shifting. And the second you get away from beta and go into alpha, and so when you think about people who are responsible for very large sums of money, everybody in this room, it is irresponsible to be passive in what you're doing right now. I would say it's irresponsible. You have to be sorting through the beta in order to get to the alpha. And your investors are expecting you to do just that. And so that's why everybody is spending so much time. I mean, how many nights now are you sitting there in the middle of the night looking at the screens, waking up early? It feels very much like 07, 08 time period where you're trying to find those opportunities.
All right, we're going to get into some of the opportunities that you just mentioned. But John, I'm curious how you see the world and within your mandate, of course, and whether you see a lot of opportunities like Mary, given what's happening with the Bank of England and every other central bank right now.
So look, I think I would echo everything that's been said by Roger and Mary in terms of the opportunity and kind of the world at large, if you will. I feel like whenever I get asked that question, I have to sort of set some context, which is, even though I sit on top of a sovereign-owned wealth fund, we don't get regular injections of capital from our shareholder, right? So for us, navigating these markets and think about where the investable opportunities are, we also have to think about where the inflow is going to come from, right? So divesting something, monetizing something.
You have to sell to buy.
Exactly. And so, or a dividend received, or a distribution from a private equity firm, if you will. So, that's been a significant challenge. And again, just to dimension things, we run at any point in time, even though we're not asset allocators, 50-50, 60-40 public-private. Our mandate allows us to do both. But I would tell you from an activity perspective, we're probably closer to 80% private, 20% public. The public positions tend to be larger, more liquid, investments. So, in this environment, we're really doing three things. We're taking a look at the public book, and we believe we're a little bit bearish on what the next few quarters look like from an investing environment. So where we've got a large liquid position in a name we like, think about our financial services strategy, which is heavily tied to payments, or our tech portfolio, which is heavily tied to software and some of the companies that went public. We're happy to monetize some of those, even though we want to hold them in the long term, given the themes we're investing against, and buy them in size at a lower price down the road. So we're rotating and recycling.
Can you give us are you talking about like PayPal, Roblox?
Exactly. So, I mean, we're
Everything
heavily
that's
exposed to
okay.
the big payments guys, Visa, PayPal, Bill.com. On the tech side, it's Snowflake, the Robloxes and others of the world that we bought as private companies in many cases, wrote them through the public markets. We're now rotating. Love the names. They're again, trend aligned in terms of the themes we want to invest against. But we're doing that. We're also leaning into the private portfolio. So there's a lot of companies. I sit on the board of one that was going to try to make its way to the public markets this summer. That obviously didn't happen. But it's a great company with great growth prospects. The capital around the board table or fresh capital coming in is dried up in the private markets. It's a different valuation. And so we're going to lean in and do more than our pro rata in many of those instances. And then the other thing we're doing is, because of our size, we have to take a critical look at those things that aren't going to have a material impact on a $300 million balance sheet, right? So we have way too many positions below $100 million that require time and attention. And so whether they're winners or losers, we're using that as a source of liquidity, right? I think you also have to be fairly agnostic about things that don't have a prospect of gaining return, at least in our instance, because we have to create that liquidity. We're monetizing a lot of that long tail, if you will.
So it's kind of a short-term, long-term discussion here, Roger. And when you look at the short-term, challenging, I think you would all agree, given what's happening in the world, inflation, central banks, economy. What is the long-term look like, and when does that start to turn?
So let me first start by saying I agree with Mary. Certainly, these times of disruptions are also times of opportunity. So this is not woe with me. This is being really smart and being careful. Now, to the long term, I think this is, and I've always believed this personally, we should be looking at, investors should be looking at 4 or 5 major trends that are, I think, investable and are clear, and also looking at markets that really need disruption. So major trends, obviously, aging population everywhere, and until recently, I hope returning increased longevity. So what does that mean? Healthcare, things of that space. Obviously, like it or not, a trend that we are now confronting yet again is defense spending. Likely to go up. The world we discover is a much more dangerous place than we knew. So not everyone is comfortable in that space, but it's certainly a trend to think about. I think we have a trend around some version of globalization we're going to have to understand. I also think we have an unfortunate trend to some degree as a former central banker. We've been through a period of disinflationary pressures that created some really interesting investment opportunities. And we are now going to have to get used to probably a world that's more leaning towards inflationary pressures. And what does that look like in terms of investable ideas?
You don't think inflation is going to 2% next year in the U.S.?
I think the Fed's going to work really hard to get it down. I think even their own projection doesn't have them getting there as quickly as they'd like. So we should expect inflation here to clearly come down. When it hits 2%, I'm not 100% certain. And what it's going to take in terms of the Fed's actions maybe a little more tightening than they're currently expecting, but the world is really quite volatile.
No one's talking about transitory anymore.
No.
No,
I mean, nobody who runs a company thinks that salary increases are transitory. There's no such thing. So this inflation is here to stay, and as people who are focused on everything to do with Fed moves around the world, the Fed is not going to stop until real rates are positive. And so if you look at all of the past Fed rises, and so unless we're a long way from that. If you look at 94, 95 and the playbook that Greenspan used, where he went 25, 25, then 50, and then the surprise 75, 300 basis points of move. We're exactly there. We've done 300 basis points in about half the time that took. And we are completely upside down on where real rates would have to go in order for real rates to be positive. And so there's an enormous amount that has to be thought through. And every time you see these rates go up, every single forward earning of every company that you own around the world is being reset in a present value term. So like every day you're trying to do that and think about it, which is why private markets are so interesting.
Absolutely.
Public markets are so interesting. We talked a little bit about those who have private investments, there's this denominator effect where they haven't been reset down as fast as public markets. And so there's a whole lot of money sitting in these big, massive funds that are now over allocated to private equity markets and can't necessarily add more without selling other things. So those who can invest in private markets, it's going to be a phenomenal year. We continue to see clients, even throughout these uncertain times, adding close to $1 billion a month in alternative investments of that sort. So I think it's very interesting. I think looking around the world, places like Poland that are going to they've already taken in 2 million people into their country and trying to help through that. If you think about the rebuild of Ukraine and what's going to happen there, we spent time with Mrs. Zelenska when she was here. She came in to JP Morgan last week and spent about an hour with us talking about the country that she was a teenager in the Soviet Union, and then the wall came down and she saw an entire world change in front of her where she could become her own entrepreneur, start her own company. One of her employees ended up being her husband, and now she's sitting here facing a world that looks very different. They're not going back. They want a free and democratic society, and they're going to do everything, and the countries around them that can support that, and the grocery stores and the infrastructure. And so if you look at 1973, which was the last time that a geopolitical issue turned into an oil issue, the things that you wanted to invest in were energy, food, agriculture, telecom. Today, it's many of those same things. I would just sub out for telecom, I would sub out semis and cybersecurity. And those would be major themes you would want to be thinking about.
For public markets as well?
Yes.
Because I was going to ask where you see the opportunities. You said in stocks, in bonds, and currencies. What else?
I think that you're going to find, I mean, we've been financing real estate purchases very quickly over in places like the UK where you have currency dislocations and people want to take advantage of it. You're seeing people do things very, very fast in these past couple of days, and I think you're going to continue to see that. I also think on the other side of the world where you're headed tomorrow, I think there's a tremendous amount of opportunities that are happening when currencies move like this and you're an export nation and you can take advantage of a lower currency. Things can make things that were attractive become even more attractive. I would not bet against China for a second. I think Built in China 2025 is a very real thing, and they are investing heavily in the companies that are going to do that. I think South Korea is going to benefit from a lot of the switch in offshoring and being able to invest in battery companies, semiconductors, and the like. I think there's tremendous opportunities abound. By the way, you asked earlier about UK public markets. Last week, people said, don't invest in a single thing in the UK. That is exactly when people like us and people in the room think, let's go look right there. I think UK banks might be the most interesting thing you could invest in.
UK banks, despite the policies that we're getting from the government and the
I
central
think you
bank.
will find tremendous opportunity.
John, you're on the investment committee. You have sort of the global view. Mary likes China, UK banks. What do you think? Where are you on some of these international opportunities?
I would just echo the China comment. I think we're still relatively bullish on China. I think we're taking a bit of a pause like we are across the globe, but I think we're, it's about a quarter of our portfolio, similar size to America's and the legacy Singapore company. So I think longer term, Roger touched on some themes. We're super thematic in the way we look at things. In fact, he mentioned a few of them: sustainable living, digitization, longer lifespans, future consumption. Those are not novel themes to invest against, but I think they're enduring as far as we can see, and they're present in every one of the major markets in which we're investing. So, the beauty of our capital is it doesn't have duration to it. It can express itself in the private markets and the public markets, so we're doing a little bit of both. The public markets, again, as I said earlier, come into play in terms of creating sources of liquidity for us, but I would say 70-80% of our activity right now is in the private markets, chasing innovation and energy transition, and ag was mentioned. I used to be responsible for our global ag
You're the
portfolio.
ag guy.
Yeah, probably paying for the sins of growing up on a farm in Iowa, but we think there's tremendous opportunity there, right, in both energy transition as well as kind of feeding a growing population when arable land isn't increasing in size. So whether or not there's farming techniques, production techniques, all of that. And so we're about to do a pretty significant check for us. So we're still very much in the investing business, even in these markets, but that's a private transaction with a controlling shareholder where we want to be their significant party and help them globalize their business. So I agree, there's a
Really interesting.
ton of activity, but you got to be patient.
As
The
people
other
come
thing
on,
I'd throw in is it's an overused word to some degree, but disruption still exists, right? And so there are major, big old sectors, healthcare in particular comes to mind, where brand new ideas are coming into play. So I'd be looking for those disruptors.
is that why you're
I
going into
also-
venture capital?
I'm sorry?
Is that why you're going into venture
That
capital?
is one of the reasons I'm going into the incubation world. Is I become a partner of this organization called Red Cell Partners with a young man that I've known for a long, long time, and he and his colleagues have a number of great ideas around disrupting both healthcare and defense, and I think there's room there.
And have a successful track record
And
in
also
doing just that.
have had a successful track record in doing that. Mary knows him quite well. The other place I'd look actually, and it's back to the just energy transition. If you think about what that's going to take, particularly moving into more electric vehicles, et cetera, what are the commodities called for in that space? So copper is another place one might be looking. So I agree, there are a lot of big themes, and the theory of the case is to find first-rate companies in the public market or the private market that I think express those big themes, some of which may be large and some of which may be relatively small, but a lot of opportunities.
The one thing we haven't talked about that I think in terms of creating returns, like we're also trying to bolster what we call our operating partner ecosystem, right? Like you've got a lot of, we talk about transitory inflation. I mean, if the average CEO tenures 4 to 5 years, 2 years of inflation doesn't seem very transitory. But we've got a bunch of CEOs in our portfolio who have never dealt with this kind of operating environment. So making sure that they've got the resources available to them to navigate it and continue to generate equity, value appreciation is something, I think most people do it, but it's often not talked about.
What's the big
enough.
mistake?
Just, assuming that these people have lived through something like this before and this is experience. So whether that's populating the board with people that have seen 1973 or some other time like it, and making sure the CEO is, looking around every corner they can. This is not a normalized operating environment.
But that goes for investors today too. I mean,
Totally.
that's what's so nerve-wracking here is that most people have not lived through an interest rate rising environment. Just think about that. My first real job as a portfolio manager was 1994, 95, and it just hits you in the face. Like you are scarred for life when you live through that. So people haven't lived through rising interest rate environments. They haven't lived through major geopolitical issues like this. They have not lived through energy crisis like this. And so there's a lot of people sitting there thinking, well, the problems in Europe and the energy problems are just for this winter. That's just not the case at all. This is a serious long-term problem. Getting regasification plants built in Germany, the floating ones are going to take 1 to 2 years, and the fixed ones are going to take 3, 4, 5 years. This is a very long-term problem, and Europe is more heavily dependent on manufacturing than the United States of America, and so and Germany especially. And so when you think of companies like BASF, which is 4%, I think it's 4% of all of the gas requirements for the country of Germany. They make all of the chemicals for all the other manufacturing plants that then go get distributed across into those manufacturing. Now think about shutting those down. Think about moving them out of the country. Thinking about trying to find your way because it's not. They know it's not a one-year problem, and so there's all sorts of things that are moving around that people haven't lived through, and so they are a little bit. You worry that a young investor who would be a deer in headlights has to get grounded in the facts, has to be a student of history, has to understand these things, has to understand the long-term shifts and make sure that they know what they're doing, which is why it is all about alpha.
One thing we don't really have a playbook for, and I thought it was interesting that you both sort of expressed the bullishness around China, because that's not necessarily a consensus idea. I mean, Roger, we have this zero COVID policy.
Right.
The country is, it's only gone from bad to worse between the US and China. We're all watching to see what they do on Taiwan, and some are wondering if we're at peak China.
No, so I share a little bit of the caution around China, which is not to say it's not investable. I think you can never say that about the world's second largest economy. So obviously there are places, but I think the issue there is risk management and figuring out what the reasonable risk profile is for a number of reasons. We've clearly seen, some of the weaknesses. The question of COVID. They have, if we're thinking about big trends, they have some negative trends in terms of the workforce already starting to shrink, and they're going to have a bit of a shrinking population problem coming up here shortly. There's obviously the question of the geopolitics and how one plays that. It goes without saying. Question of opacity and really understanding, the accounting issues. And so we've heard some folks earlier on some of the CNBC shows talking about opacity and accounting questions there. So I am, vis-a-vis China, a little more cautious. So I wouldn't say China's uninvestable. I think the question is picking and choosing. And the final point I'd make there is you really need someone who's an expert in that society working with you. That is, for me, not something you look in from the outside and say, oh, I'm a China expert. So, too big to ignore, but I certainly am on the more cautious end. Having said that, we haven't talked about another huge continent that has been ignored in this conversation thus far, which is obviously Africa. Huge amount of opportunity there, and again, probably more private than public, but all these massive trends are really, I think, going to create some investable opportunities there. So I think to Mary's point, this is a time to look carefully. This is a time to be bold, but to be wise, and understanding this sea change and what that does mean about what the new opportunities are going to be.
Mary, I'm curious why I was coming in very interested to hear your thoughts on China, because a few years in a row here in Delivering Alpha, you have been bullish. And I was wondering if you would still feel that way, given the growth rate has come down a lot and they're dealing with a lot of challenges. And for American investors, I think they're thinking twice, especially after some of the sanctions on Russia.
Yeah, investing in China is not for everybody. But there's a saying, don't fight the Fed. And don't fight investing in China. It's a hugely complex market, but very uncorrelated with assets that most people hold. And it's a country that is going to emerge from COVID. It's a country that is going to put its 22% youth employment back to work. It's an economy that is going to continue to invest in EVs, semis, etc. And it is a country that has declared that China 2025, made in China 2025, is a real thing. And so there's many, many industries that will be invested in that you can choose to co-invest with them or not. We've been in China for 100 years, 101 years. JP Morgan Chase has been in China for 100 years. We have on-the-ground research, and we're seeing what is happening each and every day, feeding that back to our portfolio managers around the world. And by the way, China, for the sake of investing in China, is one thing, but being an investor anywhere in the world, it is irresponsible to not understand China if you're going to invest anywhere else in the world, because it has so many implications for the way countries and companies are investing themselves. And so I think that's a very important part of the equation for analysts and researchers all around the world, to be able to understand what are those dynamics and how are those things working. And I wouldn't bet against it.
We only have 2 minutes left. It's flown by. But John, I want to sort of wrap with best ideas. And you guys have all given us a lot of really good ones. But John, is there any one name or any idea within some of your themes that you would give the audience here to take away?
I don't know if there's one name that sticks out. I mean, I think sticking to those.
I thought you were going to say Amazon. Or
sticking to those, we missed that one. Sticking to those themes.
You own that, don't you?
What's that?
You own Amazon, don't you?
We do, but
yeah.
There's times when you buy it when you would felt a lot better about it. But again, not to punt on the question, I think we're very thematic. Those themes are going to be enduring. I do like some of the stuff in ag, but it tends to be more on the private side, right? And so some of those things are going to come public. I'm asked on the board of something called Farmers Business Network, which I'm pretty bullish on in terms of being a disruptor to the traditional, value chain. That would have been one that, again, the markets had held up. We might be talking about more. But we're software focused, we're payments focused, but we express it across, a variety of different names as opposed to.
What about the public ag names? Are those good?
They tend to be a little bit more complicated. We have been investors in them in
Bayer.
the past.
Right.
Bayer, we're a big investor in as part of the Monsanto transaction because we thought, again, it was trend aligned and there was an opportunity in terms of a transaction, and we'll stick with that one for the long term, even though it's been a bumpy ride.
Roger, what about you? And maybe within this answer, we haven't really used the R word yet about recession,
Right.
but it only makes matters trickier that we could
All right,
be
so
in or
let
facing
me
one.
speak to the R word. I've said it a few times, but I'll continue to say, I think the odds of recession are really quite high, very, very high.
In the U.S.
In the U.S. and frankly more globally. I think there are issues in Europe having to do with energy that may lead them to tip over. We see obviously the challenges in the UK right now, and here in the U.S., I think the possibility of recession is very, very high. Having said that, I think investing is a long-term activity, to the point that has been made here. And the theory of the case is to think through companies, or at least big themes, I'm in the place of themes, that are going to create investable opportunities for the next decade or so. So recession 2023, 2024, quite likely in the US and global. Hope it's short and mild. We'll see if the central banks can engineer that. But for an investor, one looks at that as, okay, that may be, surprisingly or not surprisingly, an opportunity to get some valuations that are much more attractive. I tend to be a thematic investor, as is John, long-term things. And frankly, I think for individuals and certainly institutions, getting private exposure to brand new ideas and brand new companies is the way to go.
Yeah.
You all like private.
I would also say one of the things that's happening right now is the world is descending into a lot of hand-wringing about what's happening, as they should, given the roiling of markets, both in the bond markets and the currency markets, which lead to the repricing of every asset class in the world. Having said that, while the world is focused on all the black swan events, there will be white swans that emerge. And keeping your eye out for those white swans, and very importantly, to Roger's point, staying invested in these markets is one of the most important things and one of the most difficult things. And if you look at all of the past history of when markets are the most challenging, it's usually within a 10-day cycle that you also have your best return days. And so if you look back over history, just missing the best 10 days in any market environment will cut your returns in half. And so staying invested and looking for those white swan events is maybe one of the most important things to be able to see through a sea of hand-wringing and uncomfortableness in the marketplace today.